everybody. Welcome back into Mining Stock Daily. General market commentary today with our returning champion and friend, Mr. Rob Sinn, CEOTechnician. Rob, if only we had something to talk about. Jesus, man. Oh my God.
This is, yeah. This is quite a backdrop here. I my head is spinning, between the price quote changes and the headlines nonstop. It's wild.
Well, okay. We could let's just dive in, Rob, because there's a number of ways we can take it. I want to get your thoughts on rising yields in the bond market. That's obviously causing headstorm in the equity markets. I don't know if we've necessarily seen the end. We got to talk about precious metals on the backdrop of what's happening in the Middle East. So maybe let's just start there, because I think a lot of people who are longtime listeners of this podcast and this show have some interest. Rob, I think you and I have been having this similar conversation before, is that when gold rises on the back of geopolitical tensions, once those tensions subside, gold usually pulls back. So, obviously you want a healthy move. You want a healthy move and just strong buying for fundamental reasons in precious metals. What did we see in the last week? If we go back midweek last week through Friday, and even last night, China was buying physical gold hand over fist. What are we seeing now?
That's a very hard question to answer. I think we've seen a lot of pain inflicted on market participants. I think this move in the last 24 hours from, let's say, like 1935 to 1975, I think that was shorts being carried out in body bags. And it's interesting that we ran into that 1975 level again. If you think back to January of this year, that was the peak at the end of January, early February, exactly 1975. So that is a resistance level for sure. And I feel like that move above 1950 overnight, I feel like that was just short squeeze time. I feel like that was a short squeeze at gold. And now gold's a little vulnerable, because it's had such a big move in such a short period of time. And you think back to last Thursday night, Friday morning, gold was in the 1880s. It was under 1900. And here this morning, we print 1975.80. That's a very big move. And you made a good point. Yields. I mean, what we're seeing in Treasury yields in the yield curve is frightening. 10-year above 4.9%, 30-year above 5%. I feel like there's a problem brewing in the Treasury markets, and it has to do with a combination of factors, but probably the biggest one is just a deficit, this huge budget deficit that the U.S. is running. And here we're coming into an election year in 2024. There's no way Congress is going to cut spending during an election year, right? So I just don't know how this is going to play out. It's complex to say the least.
Well, and plus that, you have Treasury Secretary Janet Yellen saying, yes, we can afford two wars. There's been $100 billion on the table there to support both Ukraine and Israel. Even the thought of cutting spending is just, listen, it can be political posturing. It can be just words out of mouth. But when it really comes down to it, we haven't seen cutting and spending in 20 years, man.
No, I mean, the numbers are mind blowing. I mean, just even the spending to, Ukraine in the last 18 months totals well over $100 billion. And now they're talking about another $100 billion bill, which I guess some of it will go to Ukraine, some of it will go to Israel. It's amazing how the U.S. is the benefactor of all these countries. And nobody has any discipline. Like, nobody has any fiscal restraint. And I understand that, Ukraine is really important, and we have to support them in this difficult time, but the numbers really add up. And at some point, that credit card is gonna be maxed out. It's, I guess we're gonna fuck around and find out.
Let's put time to put the meme up. But is there discipline? Are you seeing discipline in the bond market? Are the vigilantes here just literally coming out and saying, "We don't believe you"?
I don't know exactly what's moving the treasury market, but I think that's got to be a big factor. It's just the amount of supply that's being issued by the treasury and will be issued over the coming weeks and months. And I have to think that the supply is the biggest factor driving up rates. I know a lot of people say, no, supply is never the factor in the treasury yield curve. It's always inflation and, economic growth. But I don't buy that because, yeah, okay, we've had a period of high inflation, but now, based upon the accumulation of data over the last several months, I mean, inflation is down to about 3%. So when you see a 10-year at 5%, that's not inflation. That's something else that's driving that. And I think the market is forcing rates higher to enforce a fiscal discipline or force the Fed to, intervene again. I feel
Hmm.
like I it's impossible to predict this, and it's a moving, there's a lot of moving parts here, but I feel like this is coming to a head here with all the spending from Washington, with the big bear steepening in the Treasury yield curve, and with these rates. I mean, 5% on the 10 years backbreaking, interest rate when you could consider $30 trillion in debt.
Yeah. I mean, just on a personal note, I moved. In hindsight, I moved a large chunk of my kids' college fund into a bond market, a bond mutual fund, because I'm looking at these yields, Rob, and I'm like, I can go super conservative here and probably get better returns than what the stock market is telling me. At least in the midterm here until we get a little bit of clarity. I don't know when that clarity is going to show up, but I like these. I like these rates. 5.2% on a 2 year. Love it. That works. However, the other edge of the sword here, Rob, is I don't know if that's the high. It might even go higher. The momentum. It just seems like momentum is even higher yields yet.
Yeah, I mean, I don't think you have to go out there to the 10-year. I think you can just stick around in the 2 to 5s area and get that 5.2% yield, and then just see where things are in a couple of years. And I think that is what's pushing up, the long end rates is people are camped out sort of in that front end, or the fives, um, and nobody wants to take on the risk there at the long end of the yield curve. And I agree. I mean, if you can get 5.2, 5.3% yield with quote unquote no risk, just inflation risk, um, it's pretty attractive, and while I guess I'm becoming more constructive on the equity market here, as long as we don't have World War III, big caveat, I still think there's risk. There's plenty of risk here, to the downside in the near term. And if you're just paying me to wait and maybe get into stocks at a lower price at a later date, that doesn't seem like a bad proposition, either.
Aren't you a little surprised to see the 10 year at just under 5% and the S&P still hovering at 43.40?
Well, how about the 10-year at 5% in gold at 1960?
Hmm.
Uh, we're always told, and the correlation between real interest rates and gold has been very strong the last couple of decades. If, even if we say inflation is 4% and the 10 years almost 5%, positive 100 basis points, real yield there, you would think that would be weighing on the gold price more. But I feel like what gold is telling us, it's not just the Middle East. There's bigger factors in play here. And I think gold is seeing that we're coming to this sort of climax here in the next few months, maybe even by the end of 2023. There's going to be an inflection point, and the Fed is going to have to blink. I'm not saying the Fed's going to cut, but the Fed's going to have to blink in some way to get a handle on this, yield curve. And there's a lot of people say, oh, there could be a Treasury buyback. The Fed could help the Treasury finance sort of a yield curve, a YCC thing where they hold long end rates at a certain level and use T-bills to sort of finance the buying of the long. And there's lots of things that could happen here. And all of it is sort of a stealth form of quantitative easing, kind of just like that thing the Fed announced back in March during the banking crisis, also a sort of a stealth quantitative easing. So all of it is a positive tailwind for gold.
Yeah. Okay. So how about the gold equities here? We've seen some pretty positive moves from the bottoms in the major gold producers and even the royalty companies. We like to see that. It usually is a fairly decent sign. What we haven't seen yet, Rob, is some of that momentum to trickle down later into, we talk about curves, into the junior mining curve. We haven't seen that yet. However, slow and steady, given the last 2 years, I'll take any sort of positive news I can get, even if it's in the major gold producers. So what are your general thoughts here on just the beat down junior explorers and development companies?
I was speaking to David Lotan, a friend of ours,
Yeah.
last week, and he made a couple of excellent points about sort of the bottoming process in the junior mining sector. And he actually thinks that we are putting in a bottom, and we may have actually seen it, or at the very least, we're sort of in the very end of the bottoming process. Maybe the tax loss season will be the final capitulation here in the next couple of months that'll put in the final sort of nail in the low. And I tend to agree. I think that we're having a sort of right sizing of the sector right now, and this could play out for another several months. It could play out, into next year, where investors are just going to have to take some losses on stocks, ideas that aren't working, that haven't been working, that aren't going to work, and move that money into the higher quality companies in the sector. And really, for the sector to lift off, it wouldn't take a whole lot.
No.
Just a little generalist money flowing into this tiny little sector, this tiny little corner of the global stock markets could cause a significant, lift higher in share prices. But we need success stories. We need success stories. And, that's, new discoveries, but, stuff that sticks. It isn't fly by night. Like, we have a new discovery, it creates a spike in the share price for a few weeks, and then, oh, it's not really a new discovery, and we go right back down, right? So we need success stories that really stick and attract new capital into the sector, because we're not going to really see a lift higher when it's just you and me trading, a few bucks back and forth, with one another. I mean, that's not going to do it. Like, we need new blood, fresh blood to flow into the sector, and that requires success.
Yeah. Rob, last time you and I chatted, you shared one idea, and that was natural gas. And natural gas had a nice lift from when you said that. Just kind of curious, like anything else kind of grabbing your interest now that, out of the resources sector that might be, maybe percolating in your mind here?
Yeah, I mean, I think natural gas was a great trade there. It's pulled back a little bit off the highs, but I still like natural gas longer term. But today I brought a little prop, with me. This is a half noble, platinum noble from the Isle of Man. And my next idea is platinum. And people are like, "Whoa, hold on, aren't you a gold bug? Why would you be talking about platinum?" Well, there's a lot of actual factors that are really favorable for platinum here. I mean, first of all, the price is less than half the price of gold. So there's one factor. It's also sort of a backwater market. Not many people pay attention to the platinum market. And, investor sentiment is pretty negative on platinum. So that makes me more positive on it. And then if you just look at some of the marginal costs of mining platinum, the average cost per ounce of platinum mined is over $1,000 per ounce. And some of the higher cost platinum that's pulled out of the ground is more in like the $1,300 to $1,400 per ounce area. So there's a lot of mining companies that are losing money mining platinum right now. So if the supply of that, new mine supply starts to come down, which it is, platinum prices should move up back above $1,000 an ounce. And I'll just throw in one more thing. 3/4 of the platinum mined in the world today comes from South Africa, from one country. And South Africa is having a lot of challenges in their country, including power blackouts, labor strikes, and even mine closures. So a lot of that supply of platinum is high risk right now. And just simply put, if you can buy it at 900 an ounce and the cost to mine is over 1,000, it's kind of, I mean, I don't want to say it's a no-brainer. It could still go down, but the downside risk is pretty minimal from $900 an ounce, and it could easily go back up to 1,100 or 1,200 over the next year or so. So I like platinum here.
Well, the solution to low prices is low prices. So I guess that'd be your argument. Rob, thanks so much for your time. Listen, let's stay in touch here the next couple weeks, and we'll see how everything plays out. I mean, every day is something new, but we'll see how the rest of these markets play out. I'm paying obviously a lot of attention to this Treasury market, gold, and actually maybe before I let you go, silver was raging higher this morning, is putting in a very ugly inverted hammer, which is a very bearish kind of turnaround sign, typically reversal sign. Any thoughts on silver, what we're seeing there?
I've been of the opinion that silver is just in a big oscillating range, and I think we got to the upper end of that range here this morning. If you're an investor, I think you look to buy silver on dips under $22 an ounce. If you're a trader and you're trading silver, well, then you're just crazy. So it can't help you.
All right, Rob, have yourself a good rest of your week. Thanks, man.
Thank you. Appreciate it, Trevor.